Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate mumbo jumbo. And let's just say our subject today has some interesting moves up its sleeve, involving forward sales and borrowed shares. It's a bit like a financial magic trick, and we're here to reveal how it is done. Today we're diving into a current report, also known as an 8K filing, from American Healthcare REIT Incorporated. Now an 8K is like a company's immediate reaction to big news. It is not a regular update like a quarterly report, but rather a way for them to tell the public about significant events as they happen. Think of it as a public announcement board for crucial developments. This particular filing centers around an event that happened on the 24th of November. The company announced the closing of a public offering. This means they sold a bunch of their own stock to the public to raise money. In this case, they put out 81,000 shares of their common stock. This is a pretty standard way for companies to get cash for growth, operations, or whatever else they need funds for. Now, behind every big stock offering, there is usually an underwriter. In this situation, RBC Capital Markets, LLC, was the underwriter. Their job is to help the company sell these shares. They also sometimes get what is called an option. This option gives them the right, but not the obligation, to buy even more shares from the company for a certain period. It is like a pre-arranged agreement for a potential future transaction. And here is where it gets a little more complex and honestly quite interesting. In relation to this offering, the underwriter, or an affiliate of theirs, got involved as something called a forward seller and also as a forward purchaser. Don't let the jargon scare you. A forward sale agreement is basically a contract where a company agrees to deliver shares at a later date and the buyer agrees to pay a price that is determined now, but with some adjustments it is a way to lock in pricing and manage future share availability. So what happened on the 24th of November was that the company closed this big stock sale. Then something else happened. The underwriter exercised an option they had to buy more shares. Specifically, they exercised their option to buy an additional 1215000 shares. This is a significant chunk of stock, and it tells us that the market demand was strong enough to warrant buying these extra shares. Because the underwriter exercised this option, the company American Healthcare REIT Incorporated entered into a new agreement, an additional forward sale agreement. This agreement is with the entity acting as the forward purchaser. Through this agreement, the company is essentially committing to deliver these additional 1215000 shares at a future date. Instead of the company physically handing over these shares right away, what happened is the forward seller borrowed 1,215,000 shares and sold them on the 26th of November. They did this to hedge their positions, meaning they took steps to protect themselves against future price changes. The company American Healthcare REIT Incorporated intends to deliver these shares later, specifically by May of 2027. They have flexibility on when to do this, and they can choose to settle the agreement either by delivering cash or by giving over the actual shares. When they finally deliver the shares, they will receive cash. The price they get per share is based on the original public offering price, minus any underwriting discounts and commissions, and then there are some other potential adjustments. This structure allows American Healthcare REIT Incorporated to get most of the money now for the offering, but they defer the actual delivery of some shares, which helps manage the immediate impact on their share count while still securing funding. So, what will they do with all this money? The net proceeds from this forward sale agreement will be contributed to their operating partnership. This operating partnership, American Healthcare REIT Holdings, LP, is where the actual business operations usually take place. They plan to use these funds for general corporate purposes, which is a broad term that often includes expanding the business, making new investments, or covering operating expenses. This suggests they are looking to grow and potentially acquire more healthcare facilities or related assets. The key takeaway here is that while the company is raising significant capital through this offering and the subsequent forward sale, the actual delivery of the full stack of shares is spread out over time. This strategy can be beneficial for managing cash flow and share dilution, but it also creates future obligations. The company has until May 2027 to make good on delivering those additional 1.2 million shares. It's also worth noting that these additional shares were offered and sold under a prospectus supplement. This means they had already gotten approval from the Securities and Exchange Commission, or the SEC, through a shelf registration statement allowing them to quickly issue more securities as needed. This shows they are prepared for future capital raises. As for the specifics of this forward sale agreement, it is attached as an exhibit to the filing. This document, the forward confirmation, details the exact terms between American Healthcare REIT, Inc. and Royal Bank of Canada, or its affiliate. This is where all the nitty-gritty. The precise calculations for the forward sale price and the settlement procedures are laid out. Now let's look at the bigger picture with American Healthcare REIT, Inc. While this filing doesn't dive deep into financial tables, The actions we see here are all about raising capital. The company is essentially selling future promises of stock for cash today. This is a common strategy. If I were to look at their overall financial health, I'd want to see their balance sheet to understand their debt levels and their income statement to see their revenue growth and profitability. However, based on this filing, it is clear they are actively managing their capital structure to fund their growth initiatives. The company's strategy seems to be focused on expansion, as indicated by their intention to use the proceeds for general corporate purposes, including investments. The healthcare REIT sector is often driven by acquisitions and development of facilities. The use of underwriter options and forward sale agreements suggests they are sophisticated in their approach to capital raising, aiming to optimize pricing and timing. A notable risk here is the future obligation to deliver shares. If the stock price falters significantly between now and 2027, the company might face pressure on the cash it receives when it settles the forward agreement. Conversely, if the stock price soars, they could potentially benefit from a higher cash inflow upon settlement, depending on the agreement's specifics. Another opportunity lies in how effectively they deploy this capital. Successful investments in healthcare facilities could lead to stable rental income and capital appreciation, which is the core of a REIT's business. In conclusion, American Healthcare REIT Inc. has executed a well-structured capital raise through a public offering and a forward sale agreement. They're bringing in cash now to fuel future growth, but they've also put in place a mechanism to defer the full share delivery. It is a move that shows financial acumen, but like all financial strategies, it comes with its own set of future considerations and potential outcomes. Alright, that is our breakdown of American Healthcare REIT Inc.'s latest filing. What is your take on these capital raising strategies and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.